And that was something I kind of learned over time. I didn't realize the power of that, where brokers and agents and even owners that would come to us direct, where they start to see that you're doing stuff and they get a sense that if you're if you're pretty honest and you're straightforward, where it's like, okay, I'm going to buy this.
Hello, you're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I'm your host, Mr. Brandon Elliott. Hope you guys are doing amazing today, and welcome back. We got Anthony in the house, not like physically in the house, but a brother from another, because he's from the motherland of New Jersey, and he's been in the real estate game for 20 to 25 years. Started off as an architect, nature, realized that sucked, and it was time to switch over and do the development side. So has been doing syndications, coming up on his 40th deal, which is very excellent. I love to hear that. Focusing more on the 5 to 30 unit type of commercial unit buildings, and in the New York area, I believe. So pretty incredible, because it's definitely one of those markets that we're going to talk about, and has roughly about 100 units that have kept doing the burst strategy, as well as about 300 to 400 range of other units that have flipped over the years and sold off. So really focusing on the ground up construction piece of it. This is going to be an awesome episode. So Anthony, what's happening, man? How are you today?
I'm doing well. Thanks for having me. I appreciate it.
Yeah, of course. I appreciate you showing up. Talk to me. For anybody out there that doesn't know who you are, where you're from, your background, give the listeners and myself that 30,000 foot view for us.
Yeah, sure. So my name is Anthony Morena. My company is the Mortar Group. We're a Brooklyn-based real estate firm in New York. I've been around doing this for, close to 25 years at this point. Like you had mentioned, I started early in my career on the architecture side of things, went to architecture school, got licensed in architecture, realized that the guys that I was working for after I graduated that were kind of, later in their career back then, that's not where I wanted to be. It was kind of a bit of a tough slog for them. And I was like, okay, ultimately it was like, pump the brakes now. What can we do? Coming from architecture, I had a pretty good built-in technical sense of, buildings and construction. And that led me into development, back then there were some markets, it was kind of early gentrification years in Brooklyn. So we kind of, started off with one project, took 3 times longer than it should have, drained me to my last dollar, put me on the verge of ending, everything in there was in my account. But we got through it, we did well, and then kind of learned and kind of build it out from there. And, build out a portfolio of doing kind of ground up construction work, because it was kind of my background coming at architecture. And then ultimately moving into the rental side of things, where like you were saying, build a project, renovate it, refinance, and just do it again, and kind of built that cycle. But we did it kind of concurrently with the ground up construction. So we were doing kind of ground up construction over the years as condos, where we would build a condo, sell it out, and then, redo it again. And then while at the same time building out a rental portfolio. Mm-hmm. So up to now, over the years, the rental portfolio has gotten to just under, 100 units. We're at 92, 93. And yeah, the condo units we've been doing, over the years, and, we're about, around 350 around there. So yeah, it's been great to kind of do both, because you kind of give yourself a little bit of protection from the markets and everything else.
Sure.
And no, it's been good. It's been a long kind of ride. You kind of learn along the way. You get punched in the teeth a couple times with things, whether you cause it or the market causes it, but you kind of bounce back and you keep going. And that's kind of the key to it all, really.
I love it. Talk to me. What did the first property look like, and what year was this? What size deal was it?
Yeah. So I was in 2001. I had graduated from architecture school for like 2-3 years. I was working at this other shop, and, I bought this piece of land. It was an existing 2-family building. And the idea was, okay, we're going to knock this down. We're going to build 7 units as a condominium.
Yeah.
I had done it, working in architecture firms. Like, okay, I figure out, I know how to do this, but I was doing it at nights, on weekends, sneaking in it a little bit here and there, during my full-time job.
Yep.
To kind of get the job done. And you had to learn quickly how to do, get the financing, how to get your debt set up, how to sell, how to do the marketing, all the different pieces. So I came in knowing the construction, but I was figuring out everything else,
Yep.
and we started in '01. We ended up finishing it in like 2005, 2006.
Wow.
So it took a long time. Yeah, in the meantime, you're getting married. You take everything from your wedding and everything you've had, and you drop it into paying that contractor that last couple grand that you owe him. With what you feel is you're going to finish it and you're going to do okay, but it's hard to convince everyone else.
Yeah.
But we did it. We got through it. Learned a lot. Learned what not to do, and then kind of built it out from there. And it was kind of starting off with myself and a couple of other people that kind of believed in the idea and believed in me doing it.
Yep.
And then starts this kind of small growth over the years to kind of build out an investor group where you start with, one person, then it goes to 5, then to 10. And now we've got about 500 active investors that we work with across kind of the stuff that we're doing. But it really starts with that first project and surviving it. It wasn't the last time that we had to just figure something out and how to survive, especially in New York. But, it was a good learning point.
Talk to me about 2008. Did you, with the crash of that, like, did that smack you in the face a little bit?
Smacked me once, and then it came back around and smacked me.
I just did it a loop.
No, yeah. So in '07, so I had been working for architecture firms for a while. Then I was working for some development shops, and I had decided that I was going to quit my job in early '07, and we had signed some contracts for some new work. So I was like, okay, let's go. I'm going to quit my job. I've got enough money saved up for a year to keep me going.
Yeah.
So quit my job. You kind of start this work, and then '08 kind of hits. And at that point, it's like the market froze. Like the project that we were doing at the time worked out well. It was finished on time, on budget, but the real estate market just collapsed. And sales ultimately, it was a condo deal. There was two. One was a rental, one was a condo. The condo one ended up dropping prices like 16% by the end of the day. But then that was only half of the problem, because the other half was no one could get a mortgage anymore.
Yeah.
There were all those kind of crazy mortgage programs at that point, which probably caused, most of the crash.
Yeah.
So we had to get FHA financing, the building a proof of financing, and then ultimately took an extra year, but we got out. Investors were saved. They made, a little bit of money, which in comparison to the stock market at the time was pretty good. So they were happy. And that started kind of like growing the faith of investors. And then, yeah, by accident, we had this rental building that we didn't sell it. We ended up holding it, and we still own it. And it's just been one of those great kind of assets. And it was kind of the first where you got a taste of, okay, if I build a rental project that's in at market rate in New York City,
Yep.
Hold it for as long as you can, don't sell it. And that became part of the motto and the game plan.
Okay. I love it. How's the last couple years been after the rates went up, and have been playing games with a lot of syndicators in the space?
No, it's been tricky. The ground up construction stuff, coming out of COVID, the work we had during COVID sold, we finished that stuff up. And then you're coming out of 2021, 22. It's like, all right, COVID's over, kind of let's go. Let's, markets are down. Let's kind of hit the market going. So yeah, we signed up some new stuff. And some of that stuff got into trouble because when you do ground up construction, the bank is going to put aside interest reserve. They're going to say,
Yep.
okay, you're going to borrow this money for 30 months, whatever it is, and it's at a set rate. And back then, it was 4.5% for construction debt. So the bank modeled it based off of that. But then you hit 22, and you hit like April of 22, and it starts to go up. And then a year later, it's like, all right, interest reserve is depleted, and your 4% rate is now 9, because construction debt in New York, even with any bank, is floating. So you're based off of prime and LIBOR and all these kind of things. So you're stuck. So, the goal then becomes finish as quick as you can, make the adjustments and get out, so we've been doing a lot of that. The rental product stuff that we had done, that stuff worked out well. You can kind of manage the cost of the debt, because the rental rates kind of went up so much in New York between 21 and today, where we started off where, rents for one bedrooms were in the 2000s, 2020, and now they're $4,000, $4,200. So it kind of, that's in Brooklyn. So the numbers kind of shot up. And, the key, like for New York has always been, or it's even more so now, you've got political games that kind of go on in New York City. You've got the mayor election. That's a big topic now. You've got rent stabilization, which is kind of also a big thing in California. And you're always kind of navigating that. And so for us, I kind of learned avoid rent stabilized assets, as best you can. There was a window where we could do it and we could do it well, but they've closed those holes or those opportunities where you can make something profitable. So you can't really do it anymore. So now you've got to stick to market rate. So now we'll buy a 2-3 family, convert it to a 7, or buy a group of those kind of buildings, convert them all to like 6 or 7 units, rent them out, which because the rental process is pretty easy, like units will rent, pretty fast, and then you refinance and you just hold. We've had to do shorter term debt over the last couple of years just to kind of get us through this kind of hump that we're in now, which is finally starting to settle. So I think over the next 18 to 24 months, you'll start to refinance stuff out for like the longer term. And then just park it and hold it and let it do its thing. You get the bonus depreciation, you get the tax benefits out of it, and you just let it roll. So
that's the plan over the next couple of years. You're obviously nobody's got the crystal ball, but you're believing that rates will come down a little bit more, and in the next 18 months or so, you should be able to refinance for the long run.
yeah, I think even a lot of the lenders you talk to, they're kind of seeing that we've kind of hit the peak and now we're kind of on the downside and where rates are going to start to come down. They've started to come down. The question is, how long does it take? Some people, if they're aggressive, they'll say, oh, next 6 months, by spring, we should start to see something. But, worst case, you give it an extra year while we have our stuff under construction anyway. And if we can get, we're not projecting to get back to the crazy low rates that we had.
Yeah.
But if we can get somewhere in the middle, that's a huge win because you're buying stuff that's cheaper now. The good thing about this market, prices have come down. Rental market prices have gone up, but if we can get the interest rate adjusted properly on the debt, that'll be huge. And in New York, you just got to play within the market rate box for rentals because it's gotten so difficult. And that's the thing. It's like you can control. With construction, you can control a lot of the variables, but I've learned, unfortunately, over the years that regardless of how well I do, if I'm going to get slapped in the mouth, it's going to come something from either government intervention or some sort of outside variable that you're not planning for, like COVID. So you gotta roll with the punches and figure it out. It's the best you can do.
The properties out here in San Diego, they're starting to rental markets coming down a little bit, it feels like. And so it's I'm curious if that's going to take place in other markets as well. Obviously it's winter time as well, so that's a kind of different season, but yeah, we've started to see that. And so as far as rates go as well, because I think a lot of the market and banks, lenders, they believe that the rates will be coming down. Have you seen the statistics as well of like what that will look like if it came down? For the economy, there's a lot of backlash on will this actually be the best for us, or will it dip down a little bit and then boomerang right back up?
Well, that's the tricky part, and it's hard to predict it, right? So you try to take your best estimates of what you've seen, what your experience tells you, and you try to play that, hedge it in the middle somewhere.
Sure.
But it seems like it is coming down, and like New York, so you've got the condo side. The condo side has been slow on sales just because rates shot up so much, and now it's starting to get better. But then we had the mayor election here, which kind of froze everything. So now that's over. It's out of the news cycle a little bit and kind of calms the market down. But it's always seemed like for us, 6% on a mortgage rate was kind of the golden point. If you can start to get under 6%, you will see a significant amount of activity.
Yeah.
So that's kind of like that first kind of milestone, and we're basically right on the cusp of that. So if you could hit that, I think sales will increase because it just gets a little bit more affordable.
Yep.
If you can get closer to 5, then I think things kind of take off. Prices go up, and it kind of goes from there.
I agree.
But yeah, it's tricky. And then now it's seasonal. It's like once you hit November on the rental stuff, market dies down here, and the brokers, they'll always tell us, don't bring anything else to rent until Valentine's Day. That's the marker. So that's the thing. You try to get all your leases kind of set up in between outside of those time frames, and you just kind of keep going. But it's been a strong market, and it's even here, it's like while the condo market slowed down, the rental market shot up, and a lot of people that we were renting to were buyers that were just waiting. They're like, and they're high income individuals that are taking a temporary, they want to live in certain neighborhoods, which we kind of work in like North Brooklyn.
Yeah.
And they're like, yeah, we'll take a flyer for a year, see how rates go, and then we'll move, which kind of works out for us on both sides. So it's always kind of a balance, trying to figure it out.
Yeah. When it comes down to the rental income, do you have a third party company that's doing the management with all those units, or do you guys handle that in house? Have you built systems around that?
Yeah. It's always a work in progress. The first 2, 3 buildings, I was the property manager. I
Yeah.
was the developer. I did all the things.
Yep.
And it starts to fall through the cracks, and so you had to kind of build systems. We had tested using outside property managers that I knew it early on, but I wanted to have more control over it. And I didn't want to throw away the money to spend when I have the infrastructure. I just had to kind of figure it out better. So now we have someone that's in-house that does the property management, and we kind of coordinate all that in-house, which allows us, to kind of keep a better eye on things, provide a better customer service to residents, and makes us more comfortable as well. And it's also an income point for us. The property management part was not something I planned on in the beginning, but now it's a piece of our model. So, now it's always a matter of just refining it, getting it better. What kind of platform do you use for residents to interact with, online portals for us to manage stuff. So it's always trying to get it better, but we do it all in house now. It's been effective. It works well.
Has it been profitable with the overall? I mean, you guys are doing ground up construction, so you should be able to do a cash out refinance and get basically, obviously, all your money back. But then with that new big mortgage on there, are you still able to cash flow on those assets?
Yeah. Yeah. I think, when you refinance out, the goal is always to take out as much money as you can versus capital. And it's obviously it's been harder to do it over the last, 3, 4 years, but the stuff we had done before that was a lot. And it's for us, it's like even now, if we're taking some cash off the table on a refi, we'll look at it from the perspective, okay, we have some money still in there, but what's our return on that money that's parked in that project? And
Hmm.
you're shooting for like a double digit annual return on that money that's in there. And if it kind of fits, checks those boxes, then we're in good shape. That's always kind of the ideal. So for a lot of stuff that we're starting to plan out now, it's kind of fitting into that kind of thing where we're gonna refinance, you know, a good chunk of the equity out. If rates really go in our favor and drop over the next 18 months, then we'll pull everything out. If it doesn't work out that way, then we'll hold some, but we'll project to have a good return on that money. So it's not completely just sitting there earning, 2% on the rent. And then we'll
Yeah.
take a fee on the project management, the property management of the asset, for the life that we have it. And it helps kind of cover office costs, staff and everything else. So it's a nice kind of balance, but it took a while to kind of get there because I screwed it up, 15 different times because you have a wild idea. You want to try to see if it works this way. It doesn't work. And so you're always kind of adjusting it.
Yeah.
I think that was one of the downsides of coming out of architecture school was they don't teach you finance or business or anything else. And you come out into the world and you get hit in the face with it. And then it's like, all right, we got to figure it out. And it's a slow kind of, build up to make it work.
I
But you
love
get
it.
there. You gotta keep grinding at it and you get there.
Yeah. Talk to me about these deals. Like, how are you lead generation wise? How are you getting these opportunities? And how is it actually working with the city?
So as far as the deals come, you know, back in the day was when we're kind of just trying to keep my eyes out, what's on the market, what's selling, what's a good price,
Yeah.
so that I could execute quickly.
Yep.
Or try to see where I could find more value where maybe someone else wasn't. So it was a lot of stuff that was on the market. It
Okay.
was it was also talking to a lot of the local brokers that were kind of maybe more old school that didn't have LoopNet, didn't have all these kind of online things. It was more kind of they put a sign out, and they have a local kind of connection. So it was trying to kind of keep an eye on those people and talking to them. Then now, as the years have gone on and people have seen and brokers know that, about me, what we do, and that we'll close on deals, now we get a lot of stuff that's presented to us. It's like, hey, we've got this rental deal that's coming to market in 2 weeks. Would you be interested?
Mm.
And we'll get kind of first crack at it. We'll run the numbers real fast in 24 hours, a day or 2 days, and then we'll put an offer out. And a lot of times we'll try to snag a deal that way, where it's headed for the market, but we'll get a first crack at it. And that was something I kind of learned over time. I didn't realize the power of that, where brokers and agents and even owners that would come to us direct, where they start to see that you're doing stuff and they get a sense that if you're if you're pretty honest and you're straightforward, where it's like, okay, I'm going to buy this and I'm going to close, and you don't play games at closing, which
Yeah.
it's tricky because in the beginning when you don't have the money, you need to kind of finagle a little
Play
bit,
games a little.
you got to play a little bit.
You got to play the
But
game.
as you have to, because it's like you secure in the beginning, you secure a deal, and it's like, all right, I need $100,000.
Yeah.
That's 30 days.
How
Where am I
we gonna
getting?
do this? Yeah, yeah.
Yeah. So it's kind of playing that. But then as you go and you start to build out the portfolio, people know you're going to close on a deal and you're not going to try to retrade.
Yep.
So you start to get it. You do the opportunities. So that's been a big part of it. Yeah. Forgot what was the second half of the question.
In today's market though, is so it's more the resources, it's not so much on the market anymore. It's more just like resources of people knowing your integrity and that you're a man to close.
Yeah, I think that's where you get the first crack, but you're still always kind of scouring online or,
Sure.
in the neighborhoods that you're driving or you're doing jobs around. It's like, hey, what pops up? Or, we're doing a project now where we bought it a few months ago. It's under construction. And then the neighbor was like, hey, what are you guys up to? And it's like, oh, we're doing this. And he's like, oh, I was thinking about selling my place. I'm like, all right, great. Happy to talk about when you're ready. Give me an opportunity. So it's kind of that kind of thing as well. But you're always trying to scour for listings to see what pops up, what falls out of contract, deals that are, distressed deals that start to pop up, especially the last few years where someone was planning to do something, it's going belly up. The bank takes it back. They're like, hey, what do you think of this?
Yeah.
You're really trying to you're scouring every resource to try to get access to deals, and that's hard sometimes, especially in New York, in the neighborhoods that we work on. They're popular neighborhoods because the rents are good, the market's stable, so you've got to fight for deals, and you gotta keep an eye out. You got to be able to move quick, so it's a combination of all different things, but you're always looking for a for sale sign that pops up, and it's like, all right.
Yeah.
Look at, pull the car over. Let's take a look at this. What is it? And you reach out the same day and just try to, you act fast and you try to secure it before anybody else gets a crack.
I love it. Talk to me about the city though. Like how is it? I know we both live in some deep blue states where the city, it can make it a little bit more difficult to do some real estate stuff. So what does that look like? How's your experience been working with the city?
Overall, it's not bad.
Yeah.
You've come to accept certain things that will
Sure.
make no rational sense.
Yeah.
They boggle your mind, but it's like, all right, this is just the way it works. So then the question is, how do you minimize the brain damage? So the big thing for us is, in certain parts of New York, you can buy something and say, okay, this is the zoning that's allowed. It's as of right. You're not going for any special permission or approvals. Or you can try to extract more, but you're going to have to get involved with community boards, the politicians, and different levels of bureaucracy. That I try to avoid, just like the plague. There's, I try to find stuff that we can do as of right, where, okay, I can turn this around in 30 months. That's usually our goal. From the day we close on a deal to the day we're either refinancing or selling it, 30 months is kind of our sweet spot. Because, early in my career when I worked for, other developers, you start to see special approvals. It's like an extra, in New York, it's extra 2 years of just bureaucracy going from one board to the next, and then they make changes. And then new people come into power, and then they decide they want to change things and make it their own.
Wow.
So it's like you can't
It's a nightmare.
Yeah, you can't operate that way, and especially when you've got other money, investors' money on the hook, and
Yep.
they're trusting you. You gotta
move quick.
pick your battles. Yeah,
Yeah.
I feel like it was easier, and the market was different maybe 10 years ago or even before COVID. But now I
Sure.
think people are sensitive to it, and you want to make sure you can do the right thing by them.
Yeah, that makes sense. Yeah, I have a ground up construction. We're doing some ADUs out here in San Diego, and it's literally been 4 years with one of the properties, just going through the ringer of back and forth with the city. And there's a fault line and there's other things, but it's like, my God, it doesn't need to be like this,
Oh, yeah, and it makes you crazy. And ADUs, they're trying to introduce those to New York. I think right now the recipe that they have doesn't work.
Yep.
But it's a start.
Yep.
That's the thing. It's like they have to test it out, see if it works. Then if it gets popular and the people want it, because the whole thing here, and I'm sure just like California, is prices are high, land
Yep.
prices are high, rents are high, and everyone's throwing a lot of things against the wall to see if they stick to fix it. But it hasn't really worked out yet. It's making it worse. But hopefully, you always try to be optimistic, but in the meantime, you try to do what you can do to kind of, do the best you can for the investor group, make for yourself, where you can kind of build your portfolio and just kind of keep going. Once you get into a system, it's really the rinse and repeat.
Yep.
You can, different in different parts of your career, sometimes you're like, oh, I want to scale. I want to build this out. I want to build 100-unit buildings. I want to build, high-rise towers. And it's like, all right, no, you put your toe in that water. It's like, it's not for me.
Yeah.
And because I know I can execute here quickly and efficiently, and I know I'm gonna hit it. So I kind of now at this point in my career, just do what we do well, and just kind of have some fun with it. Just make it better, make it more efficient.
I love that.
There's so many ways you can go to kind of once you stick to one thing, it's like how do you maximize it? There's so many ways you can go.
Yeah. That's actually a great topic because being in I wouldn't say smaller type of commercial real estate, but there is a certain level that when you get like 80 to 100 doors, you can typically afford the in-house property management, right? And so the numbers just work out in a different kind of demeanor there. You just kind of leaving those statements before of finding your lane and kind of rocking at that. What have you thought about other areas or like, because it sounds like you didn't jump around too much like some other crazy people and like myself, or
It was a good idea,
yeah. But you found one thing and you're like, hey, this is the meat and potatoes. This works for me, and it's what I feel comfortable with, and it's making money and it's making impact. So why not the 5 to 30 range?
Yeah. It's tricky, it's the numbers sometimes kind of they would play with your head for a little bit.
Yep.
Because sometimes 50 to 100 doors in different parts of the country, you could do it for 10 million or under and stuff like that. In New York, sometimes that's only 10 million bucks is only going to get you 5 to 10 units. If you're in Manhattan, it's going to get you less. And it's always it messes with your head a little bit because you feel like you need to make it bigger. But if you start to do 50 doors in New York City, that's a $50 million deal.
Yep.
So the numbers change dramatically and the risk profile changes. That's also a big part of it. But to your point, with COVID, I started to look in different parts of the country.
Yeah.
And I was a little gun shy, to be honest, because I wasn't sure of what I'd be getting into. Because you're starting to look at areas and it's like, okay, I grew up in New York and New Jersey. I know nothing about Texas. I know nothing about Florida. But now I'm doing Google searches and I'm looking at a Google map of this site and I know nothing about it.
You feel out of place for a second.
Yeah. So I was like, okay, I pulled back a little bit, and granted that probably wasn't the best decision because, those markets took off. But I think now I have a better handle on those kind of areas because I've been just trying to keep an eye on them. And I think now is one of those things where we're going to start to diversify because especially, with New York and the politics, and it kind of gets tricky where, one thing was legal and you were able to do it in, 2 years ago. And now the law has changed that you can't do it. How do you justify that to investors and to the money that you invested in that project? And it's kind of hard. So now we're starting to like diversify and look into doing other things. For me, it's in the South where it's kind of where you can try to do some new stuff. But the scary but the fun part of that, it's a brand new learning curve. Everything you knew in New York kind of goes out the window. You've got to meet new contractors, you got to get a better sense
Everything.
how much something is worth, how much it's going to rent for.
Yeah.
What comps are real, what are BS, it's always kind of, you're trying to figure that out, but it's kind of fun at the same time. And
Yep.
The pitfalls at this point. So it's like, all right, how do I do this to be smart? But yeah, I think, I was apprehensive to do it, but I think now it's kind of, you're getting forced to, and that's kind of the news in New York. So everyone's leaving. It's like, everyone's not leaving, but I think people that are investing capital are looking at,
Oh yeah.
or they're diversifying. They're splitting, some cost, we'll spend some money in New York, but we're going to look at here, and here as well.
That makes sense.
And that's kind of the plan for the next probably, 5 years, I think, for us as well, while we're doing the same stuff that we do.
It's been the same out here. There's been so many people that have left over the years here in California, and people call me crazy for investing out here in California. But it's not always for the cash flow. But if I if I could break even or get a little bit, incredible. But if I can get all my money back doing the burst strategy, the tax benefits, and then the appreciation, I know you should never bet on it, but it is something that statistically it's
Yeah.
year after year it's not doing bad. And so having those kind of in the back pocket, it's a great opportunity when others are kind of fleeing. But again, like you mentioned, kind of diversifying and
Mhm.
due diligence, not jumping into a market too fast, but seeing what else is out there and being prepared for it. What it
Yeah, and I think
team look like now?
so we're a small group. We're about, we fluctuate between like 8 and 10 people,
Cool.
and it's a small development team, and then we've got property management, investor relations in house, and we have architects as well. That just because that's kind of my background, so it was always the most comfortable.
Yeah.
So it's a small group, so we can kind of tackle. Usually we'll do, I would say, like 5 to 8 deals a year that we'll have running concurrently,
Cool.
aside from the rental portfolio, and we just kind of keep churning it. We'll reach out to investors or a pool of investors usually twice a year to see who's interested in doing some stuff, doing some new work, and we'll kind of do a couple raises a year, and that's always kind of the plan, but it's, to your point with the markets, it's always kind of tricky, but I think, building it out, even in New York and California, it's not the most profitable at times, but it's also the most stable.
Sure.
Everyone says they're going to leave, but most don't.
They all come back.
All come back. Population rates are going up. Brooklyn is going up. The jobs are here. You know, there's, if you read, it's kind of like social media with anything else. If you read too much of it, your head is going to explode. You got to separate from it and just look at the data.
Yeah.
Rents are going up, inventory is going down, jobs are going up, population
Sure.
is going up.
Yep. Numbers don't lie. Yeah.
No. So it's just looking for more of that in other places, which has kind of been the nice side of the last 5 years. There's some cities that were under the radar and now they're taking off and they're doing their own thing. And it's nice to kind of see where you can kind of fit in and try to take advantage of those as well.
I love that. Anthony, talk to me about the financing side of the business. And, I know you just mentioned about twice a year, you guys are doing some raises and seeing what's available out there. How are you typically raising capital or building those networks? And then I'm sure you guys are obviously still leveraging with banks as well.
Yep.
What does those kind of bank relationships look like?
So, it's one of those things that over the years has gotten a lot easier.
Yeah.
One, just because the first one I had no idea. You go to the local bank, you had to prepare like a pitch book, and I didn't know how to do it. And
Like slide it to them, like, can we do this? Or
yeah, is this good? Do my numbers look good to you? Does my pictures look right? And then you figure it out and you get a sense, and then it's kind of like, even the worst part of coming out of architecture school and going into real estate, I didn't even know how to use Excel. So you got to learn Excel. It's like, what the hell is IRR? What's a return on your equity mean? How do you figure that out? So it's like you figure out all those kind of things, and then you start to develop the relationship with the lenders, and the debt has gotten to be the easier part. Credit markets are always going to kind of tighten when the market goes south, and we've kind of seen that. And but we've had a lot of lenders that we've worked with, through '08, through COVID, where they start to get to know you. So it's kind of repeat business in a sense. And then people kind of move to other banks, as they're moving along in their career. So you start to build like a pretty good network of debt lenders, and depending on what you're doing, you're going to go with a traditional lender, like more a regular kind of bank, a larger bank or a local community banks, or you're going to do, for us, if we're doing a project that's like a 12-month project, it's going to be private debt. The interest rate is going to be a little bit higher, but the terms are going to be better for what we need to do to execute in a shorter period of time. Just because sometimes with a lender, you're going to have all your ducks in a row. You're going to have your approvals, everything in place. And
just slows it.
Yeah. And when you can do it, if you have the time to do it, especially the ground up construction, it works really well. But when you're doing a rehab that's going to take 12 to 18 months, by time you get all of that paperwork ready, you could be half done.
Sure.
So it's kind of almost the cost. You build in that cost. Now, because rates are high now, we're modeling for high rates. And if the numbers pencil, you're okay. The problem is really in 22 when you're modeling for, 4% and it goes to 10, that's where you're in trouble.
Yeah.
But I think now you try to be conservative, and even then you're always trying to build in contingencies and margins to protect yourself in case something goes wrong. because with debt you comes personal guarantees and all the good things. So you got to, it's, I always say we, take personal guarantees, but it's me. It's my house.
When we say we, we're actually just talking about
Yeah.
me.
Yeah. So it's like, you've got to protect your house, and my three kids that live in the house. So you want to make sure you can finish the project and you could do what you said you're going to do.
Yep.
And then on the investor side, it's kind of been a slow growth. It's been, building out a base of investors that have seen kind of what you could do in good times and bad and how you deal with it. How do you
Yeah.
talk to them?
Yep.
I think the biggest thing I learned was during, 2020 and 2021 when you're kind of, all hands on deck trying to navigate COVID and shutdowns and price cuts and everything else.
Nobody paying rents and all the other.
Yeah, you're dealing with all that stuff, but you're not communicating it well to investors.
Woo.
And then it's like, all right, I got to do
Never
a better
good.
job at this. So you start to build in those systems. And it's like you start
Yep.
to do webinars. You start to do, we always did like quarterly reports, but it's like more kind of like just talking to people. It's like, hey, this is where we are. The market's doing this. You're reading that, and then that's where it's like for us when we do syndications, you're in, the people that are investing, it's individuals. It's someone that's got a job, but they're putting some of their money into an alternative asset like real estate, and they're trying it out. It's not institutional capital, but it's people. So it's more kind of like, hey, if you read something you're nervous, give me a call. Give me a call. Give someone in the office a call, and let's talk about it. Let me see if I can make you comfortable with what we're doing, and you kind of go from there. And I think people have appreciated that a lot more than I expected.
Yeah.
Because I didn't think about it, because you're more kind of like you're putting out the fires on your project. You're not forget about the human aspect of it. Someone invested with you, they don't know you. You're doing everything you can to make sure they're safe and the money's safe, and you're going to try to kill it on the project, but they don't know that sometimes. So you just have to keep
Good.
everyone in the loop.
So
And that's
good.
that's been helpful. And then that's kind of helped slowly build out the group, and you keep going from there, and try to do well.
Have you been doing like webinars to present things and raise, the network that way? I've heard a lot of successful stories over the last couple of years doing it.
I think over the last 2-3 years, especially like I was saying, like coming out of COVID, we did it a lot more, and now we do it more frequently. And then we also kind of talk to investors where if someone, because a lot of people will meet, they don't invest with us right away because it takes time to get comfortable with, hey, I'm going to cut a check to invest in a project or
Yep.
in this sponsor. They have to get comfortable. So sometimes it's like, hey, just keep an eye on what we do. Here's a webinar. Here's
Yep.
the project we looked at a couple years ago. This is how it ended up. If you're in New York, come see it. Come check it
Yep.
out. When the projects are done, you do the open houses, you do model apartments. It's like, hey, come see it. Come check it out. See that it's a real address, that it's not, my house in the Bahamas.
Yeah.
There's a real property here that we did and we executed. And then people ask, hey, what does the budget look like? How did the budget look versus, where it started?
Yep.
What went well, what went wrong? And I think, yeah, you talk about that kind of stuff, and webinars have been really, really effective. And then also kind of like you start to show people, the other part is like, with the rental stuff, and because you have a portfolio, bonus depreciation, investing with your IRA,
Oh yeah.
maybe that becomes commonplace and you just know to do it, but you realize, okay, other people are just kind of starting out. And it's like,
Yeah,
yeah,
I don't know.
and it's like it's not rocket science. It's really just you got to figure out how to do it. And then once you do it once, you can just start to do the same thing over.
Yep.
And then now with bonus depreciation coming back into law, now it's like, all right, this is back on. This is a viable part of your business plan. And it's a nice bonus where you can kind of write off a big chunk of your gains, if not all your gains, on a rental deal. So, now it's just getting, it's education on that part, and, teaching everyone else, how to do it, and, because everyone's got a different tax strategy. Everyone has a different plan for retirement, where you are in your life. So it's like, all right, it's like, hey, what are you looking to do? And maybe it's a fit, maybe it's a not, but you try to present the options and you kind of go from there.
Yeah, that's fair enough. And
Yep.
totally, I couldn't agree more. When it comes down to the banks, when it comes down to the 10, 15, $20 million loans and so forth, it can add up. And a lot of banks, they have certain limits of how much they start feeling comfortable or not comfortable. So I assume, but I don't want to assume anything, but I'm figuring that you probably have to, I wouldn't say jump around to several different banks, but utilize kind of a wide range. Is that correct or
Yeah, no, I think it is. You want to minimize your risk by consolidating debt all in one place, and you keep all the lenders aware of what kind of work you're up to on the different parts of different deals where your projects are, and yeah, but you definitely want to kind of spread the risk a little bit. Because sometimes things get cross collateralized where it's like you take a loan on one thing, but somehow now it's tied to a second deal. So you want to try to avoid that if you can. And it helps that in the event of you try to pick and choose your lenders based off of, okay, if something doesn't go well,
yeah.
is that bank going to try to work with you, or are they going to try to do something else?
Yep.
In New York, there's predatory lenders. So it's like
Yep.
and if you're coming new into the field, you don't know who they are.
Yep.
And that's kind of tricky. And sometimes even just spreading your risk a little bit helps you to kind of, dodge some bulls. And then once you're in the business a bit, who to work with, who's good, who's a reputable lender, and you navigate it that way. But it takes time. When you're doing multiple projects, you always have to start with one because you've got to build up liquidity to
Yep.
show to the lender. It's like, hey, I can do this, and if something goes wrong, I could withstand the storm, if you will, right? So it's kind of like starting off with that one project and going piece by piece by piece, so that now it's like, okay, we can do a few projects and they're still comfortable.
Yeah.
And that's that once you get to that point, that's really kind of the key to it and managing it.
Yeah, I love that. Anthony, when it comes down to some of like the learning curves over the years, you mentioned predatory lenders and other, I'm sure you've seen a bunch of crazy, wild things. It's New York, right? There's
Yeah.
God knows what takes place. So anything that would be beneficial for somebody brand new trying to get started in the Big Apple?
Yeah, I think, whether it's New York or anywhere else, it's kind of the rules are the same. It's just the characters change.
Sure. Good.
It's really kind of, when you're young, and when I did the same thing, you want to tackle the world and you want to come out guns blazing. And it's just like, if I tried to do two deals my first 5 years instead of one, that would have been it. I would have been over.
Yep. Yep.
It's like finish one, you know, and I didn't realize it in the beginning or even midway, really how important a track record was,
Yep.
where people want to see what you're doing, what you did, and that goes a long way to telling your story, and making people comfortable with you. Because it's kind of really be patient, build a track record. You don't have to you're not going to retire on the first project. You're
Yeah.
going to learn,
Yeah.
if it goes well, you'll make some money, but don't go, spending it, at all on the first one. Just take it, recycle it, take your lumps or learn what you can and build into the next one. And it's a slow kind of road. And, the market's not always going to work with you, but when you get the market, you can't time the market,
Yeah.
but when you're in the middle of something and the market starts to go with you, there's a magical feeling about that I can't explain. Like, even sometimes we'll talk about in the office where it's like you have an open house and all of a sudden there's 100 people that show up for that open house, and you sell out a condo project in a week. That's beautiful. And then you have like asking prices that kind of like, it's the bidding up, and it's like, oh, that's great. But then you see the downside when it takes longer to sell, but it's like when you see things go well and everything clicks, it's very addicting, and it's like, all right, this is great. You just gotta build up to it, so that the other part of, like, even New York, California, it's like you see a lot of people go out of business.
Yep.
People get eaten because they took too much leverage. The credit they took too much debt, and when the bank comes calling, even if it's a good guy at the bank that he likes you and you know him, and it's like the bank has to do what it has to do. So it's like just piece by piece, build it out. Don't over leverage yourself.
Yeah. Gotta have backup plans with that, right? Yeah.
You have to have the backup plans. Like, even with COVID, we had trouble with work, but you had to have backup plans. You got to build margins, contingencies for the worst side.
Sure.
Don't project, don't build out your performa based off of what you want to happen.
Yeah.
You pick that middle point, and if it hits and it's a home run, that's awesome.
Yeah.
You got to plan for it to be a single as well. And, as long as you could live to it to see another day, that's kind of really the big thing. And over time, all of a sudden you wake up one day and you've got a nice portfolio, and it's like, hey, how did that happen? This is great. My debt
Amen.
is low.
Come on.
And the models are kind of, then you could start to recycle. And then
Yep.
once you do that, then it's off to the races. And it's a lot easier.
Yeah. So you're telling me it's no overnight success for you. It's a slow and steady game, right?
For me, 100%.
Yeah, I think that's
You
the only way out there.
know.
No Instagram success overnight thing, but
No,
I
it
love
takes time.
that.
No.
I love it. Anthony, talk to me. What does the future look like for you? And then how can the listeners get a hold of you?
Sure. So for now, we're kind of doing what we're doing in New York and in Brooklyn. I think the market in New York is going to pick up.
Yeah.
So we just finished a capital raise, and we'll do about 2 raises a year. So we'll do our next raise come in the winter, but doing a lot of the same stuff that we do that is we have built kind of a good track record for, and that we can execute. So we'll be doing that. That's kind of the next step for us, kind of, coming out of this rate environment and what we think and what a lot of people look like, where, they say the market's going to pick up in the next couple of years. So we're looking to kind of see where that goes. In the meantime, we're kind of looking at stuff outside of New York and kind of see what opportunities present and kind of keep on doing what we're doing. Locations change are great. My hair is gone, so I got no hair to lose anymore. So just let it roll.
Let's let it go.
Let's let it roll.
Yeah.
And just kind of doing more of that. And, we're in New York. If anyone's interested in reaching out, we're at mortargroup.com. You can find me on all the socials. And, my big thing is kind of like just having chats with people, talking to people, kind of see what they're looking to do. If there's any help we can provide to people that are early on, especially now, because at this point in my career, it's like you start to look back as like, oh, when I was coming up, I wish someone would have told me about this, or this.
Sure.
So you've got this weird kind of thing where you want to start to share it with people. It's like, hey, this, keep an eye out for this, or maybe you could do this, where if I had to go through this pain 10 years ago or 15 years ago, maybe you don't have to go through it, or you can kind of skip it, or you've got an ingenious way or a creative way around it, because that's the thing. When you're young, you're always finding the angles, what's the way to get it done. So it's like, yeah, you're always kind of curious and trying to, kind of give it back a little bit and teach, people what you've been up to and kind of go from there.
I love that.
Yeah.
Well, this was a wealth of knowledge. I appreciate your time today. You just spent an hour with us and the listeners. Anything that either myself or the listeners could do to give back to you?
No, this has been great. Just, giving me the opportunity to talk about it. It's something we're trying to do. So no, this has been great. Appreciate it.
Awesome. Well, I appreciate your time today. Guys, I highly recommend reach out to Anthony. He has a wealth of knowledge. He's really doing this and making an impact in his area, in his community. And you guys can learn from him as well and check out some of his deals. If you guys want to get a hold of me, you can always do so on Instagram. It's Brandon Elliott Investments. Otherwise, our business page, Credit Counsel Elite on Instagram. If you're looking for funding, that's what we do. We really do help people get massive amounts of funding, up to 90% approval odds, up to 500,000 with rates as low as 0%. If you're looking to get access to that, check out creditcounselelite.com. That's www.creditcounselelite.com. There's a quick video on there, explains a little bit more. And at that point afterwards, you can feel free to book a call with either myself or somebody on our team to see if it's a good fit and kind of give you a roadmap to give you a second opinion. With that being said, if you have not already subscribed to Ready, Set, Go, Real Estate Investing Podcast, what are we doing? What are we doing here? Do that right now. Stop what you're doing. Hit that subscribe button. You'll get the newest notification every single Monday. At that point, listen to a few, then leave that 5-star review. Love all the support. You guys are amazing. Keep it coming. We will see you next week. Top of the hour. Love you guys. Till next time, God bless. Anthony, appreciate you, brother. Thank you.
All right. Thank you.
See you guys.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.